this screen over here, it might look like I'm looking out of the window, but I'm actually looking at my own screen. So I'm the CFO. I joined NetScientific 2 years ago. I used to work for Allergy Therapeutics. So Allergy for 14 years. It was a spin out from GSK. I took it public in 2004 and spent another 12 years raising funds to fund 15 clinical studies, and we grew the revenue from 10 million to 60 million. And I left Allergy because the opportunity for NetScientific came along, and I really liked the assets that NetScientific were investing in. Now, NetScientific, it's, I don't read the disclaimer, it'll take all night. NetScientific focuses on game-changing life science investments. So very simply what we do is look for IP from universities and institutions, and we build management teams and companies around that IP, and we develop the companies. You'll see that the companies, if you look at the map on the left-hand side, the companies are mainly based in the US. So what we offer investors is the opportunity to participate in US privately owned companies that we can invest in, and then the investors can invest through NetScientific, which is listed on the AIM market. And we look at chronic diseases. That's our area of focus. And I'm going to pinch the phrase you just used. There's a tsunami of old people coming over the hill. And it's great because everyone's living longer, but the problem is we're all going to live with chronic diseases. And one of the issues that all health services are having to face is how they're going to deal with people who are living longer, living with chronic diseases. Now, we look for companies that help deal with those problems in particular. And we focus on 3 areas: digital health, which is essentially things, well, the companies are called machine learning companies, and we'll talk about that in a bit more detail shortly. We look at diagnostic companies, and we look at therapeutic companies. And we list the companies below. We'll come on to those in a few minutes. And then lastly, just in terms of the summary, I'll talk about our investors very briefly. So we've got 4 key investors in NetScientific. Woodford, you may have heard of the Woodford Investment Fund, and that's Neil Woodford, who's quite well known in life sciences. Invesco, another well-known investor, and J.O. Hambro. And then the founder of the company is Zima Trust. These 4 investors own 88% of our company. So we're very well supported by quality blue chip investors. We've got a good board. We've got a fairly small board, and we've got a very small management team, and we're going to keep it that way. So we're a lean and mean management team and board. Our chairman is Sir Richard Sykes. He's fairly well known. He used to be the CEO and chairman of GSK. So he's a great source of inspiration and leadership to our board. Then we have Francois Martelet, who's the CEO, and Francois is an oncology expert. He's a medical doctor. He's worked in both small and large companies, and he's taken a number of blockbuster drugs to market. And then the 2 other non-exec board members are Professor Stephen Smith. He was CEO at Imperial College, and Barry Wilson, he was president of Medtronic and Liddell International. So we have a very good, high-quality board. And what they all have in common is that they're all experts in life sciences. So we're not an investment company run by bankers or investment people. We're an investment company run by life science people who can choose the right kind of investments to put the money into. This is our business model, and this is a fairly common business model for companies in our area. So we look for new opportunities in various institutions and universities, and they're listed on the left-hand side, like the Bloomberg Institute, Queen's University in Belfast, etc. And essentially what we do is find this kind of cutting-edge potential, and we build companies around it, and we fund these companies for quite a long time until it gets to the point where we think we can bring in new investors and we can develop the assets further. Now, what's really important is that most of the companies that we're invested in are on the right-hand side of this line. So you'll see they're all listed over here, with the exception of one, which is PDS. And PDS it's called preclinical. It means they've had a few patients go through the clinic, but essentially they need to run more studies. But all of the other companies are in what's called the external financing sort of rounds, where we're raising now external finance, and they're all at the commercial stage or pre-commercial stage, so they're quite well advanced. I mentioned our investors a few moments ago, and they've been very supportive, and of course it's critical for any company that's listed to have very supportive shareholders that support the company whenever they go back to the market to raise more capital. And NetScientific floated in 2013 when it raised 30 million. It's gone back to the market in 2015 and 2017 and 18 to raise more capital, and each time all of the main institutions have supported the company. The reason why we go back to the market is the companies we're investing in require investment to develop them until they get to the commercial stage, which is where they've got to right now. So the investors have been very supportive, and now that we've got to the commercial stage, we've managed to bring in new investors to help with the share register. Why did they support us? Well, they like the things we've been doing. The current management team have been in place since 2015. When we took over, we had to do a bit of a cleaning up of the portfolio. There were assets in the portfolio of NetScientific that weren't all life science assets. And what we've done is we divested those assets that weren't life science assets and only focused on the things that we really understand well. And also, any of the life science assets have to have a large commercial potential for us to be interested in them. So we've whittled the portfolio down from 18 investments to just 5. Next thing we did was we put in place in those 5 companies really well-known, well-trusted CEOs to run those companies for us. And then lastly, we wanted to demonstrate that the business model worked, that we could actually have an exit from one of these assets. And because, of course, unless you have an exit and generate cash, you can't continue the cycle and find new investments to invest into. And we had an exit in April 17, and we sold one of our smaller investments in one of the companies for a ×3 cash return. So we sort of proved the model worked to our shareholders. So here is the portfolio. There are 5 main investments. You'll see that 4 out of the 5 are in the US. There's 1 in the UK. And if you look at the types of companies, they're mainly cancer-focused life science companies. So there's a cancer diagnostic test for liver cancer. There's Vortex, which is it's called a liquid biopsy company. And liquid biopsy is really interesting. So anybody with a tumour at the moment, if you want to have any information about the tumour, you have to take a physical section from that tumour. Well, what scientists have discovered is those tumours shed cells, and in fact you can get a sample of a tumour cell from a blood sample. And so this company uses new technology to extract tumour cells from the blood. Proaxis is a non-cancer company. It looks at people with lung disease. Wanda is also a non-cancer company. It's a digital company, and we'll come on to that in a bit more detail shortly. And then PDS is also a cancer company with a potential cancer treatment in head and neck cancer. All of these companies are generally late stage, either late stage clinical, as in the case of Glyco Test, or late stage in terms of commercial development, as in the case of Vortex, Proaxis, and Wanda. The only early stage one is PDS. And then you'll see from the shareholding percentages, and these are the fully diluted percentages, that we own majority positions in the first 4 companies. We don't in PDS. And this is really important because it means we control the companies. We're on the board of the companies and we control the boards. And we can actually steer them in the direction we want to steer them to get the best value out of them. And then lastly, in summary, 3 out of the 5 are in diagnostics, 1's digital, 1's therapeutics, and it's generally accepted that diagnostic companies are lower risk in terms of development risk. So when you're looking at these kind of portfolios, it's always pretty good if there's a weighting to diagnostic companies because it's lower risk. So what I'm now going to do is, because it's quite a complicated company because we invest in all these different assets, I'm going to focus on 3 of these investments and go into a little bit more detail and give you a flavour for what these companies are doing and why we invested in them. So the first one we'll look at is Wanda. It's essentially an artificial intelligence company that can monitor patients remotely once they've been discharged from hospital, and it can predict problems before they arise. I'll talk about that in a bit more detail shortly. We always look at the pedigree of companies when we're investing in them, and Wanda's got a fantastic pedigree. If you look at the left-hand side, you'll see that it's based on research at the University of California, 12 years of R&D in the UCLA, where they've run 8 major clinical studies demonstrating real-world utility or use of the software, and they've got 9 patents protecting the IP. So, what exactly is it? Well, it's a piece of software, and what it does is it allows you to monitor how patients are outside of the hospital scenario. So here we have our little blue person. He's blue because he's been ill, and we take data from him, data from his patient records, data from his symptoms, and whether he's complying with his medication, and also data from devices that he might be using, like blood pressure cuffs, weight, glucose levels, that kind of thing. And all this data is fed into a series of algorithms remotely. And these algorithms are predictive algorithms. So this is being used at the moment in patients who have chronic heart failure. And it's for patients who have been in hospital, have recovered from the heart attack and are discharged. And what it's trying to do, and it's doing successfully, is it's predicting if some of those patients are going to have a second heart attack up to 5 days before they have the heart attack. And clearly the reason's obvious why that's important is because you can treat the person more effectively if you think they're going to have a problem or you know they're going to have a problem rather than waiting for the problem. So it's really interesting software and algorithms. And this is really actually the way health systems are going to go to help look after people better when they're discharged from hospital and to try and keep them out of hospital and being readmitted. So just in summary for Wanda, what do we look at when we're making our investments? Well, we make sure there's a problem we're trying to solve. And in this case, the problem is there's an aging population with chronic disease, and we need to give those patients better outcomes and to try and keep them out of hospital. The solution is our software, which we have proven in tests with one of our customers that people with chronic heart failure were 46% less likely to be readmitted into hospital using the software than not using the software. So we know it works in that population. And we know that there's an enormous market opportunity because we need to provide solutions to the problem of a creaking health service across the Western world. So the predictions for market opportunity are just staggering. I mean, remote patient monitoring market is $32 billion worldwide. And the population for health management market by 2021 is forecast to be $43 billion. So it's got a great market potential. And then on the right-hand side, we look at what we've been doing. So this is the company we had an exit from, ×3 return. We've got one contract with a company called HRS in the US, and we've been awarded key patents in the US. And in the green section, we're looking at what the future news flow will be, and we're looking to expand the service into more patients with the current provider we have, and we're looking to add more providers on the back of this data that we have. So on to the second company. It's called Proaxis. This company looks at things called protease tags. And protease tags are biomarkers for people that have lung conditions and might be susceptible to exacerbations. So a biomarker is a little bit like the Wanda technology, which is a kind of algorithm giving an indication of risk. A biomarker is an indication of risk of an exacerbation. And we've demonstrated these biomarkers work up to 60 days before a patient can have an exacerbation and need to be hospitalized. And the benefits are obvious, really, because if you can predict when someone's going to have an exacerbation, you can manage them better before they get sent to hospital. You can also lower the use of antibiotics before they have the exacerbation. And as a consequence, it's obviously a good thing if people are taking less antibiotics, but you can also keep, again, people out of hospital. This company, in terms of its pedigree, came out of Belfast University, and it's actually based in a customised premises facility in the Titanic Quarter of Belfast. It has two products. It has an assay, which is a diagnostic test which is used by clinicians, and it also has this product on the right-hand side, which is called the Neat Stick, which looks a little bit like a pregnancy test. And this has been proven in one indication, and we're looking to develop it further. And this will be the future for this company. We envisage, once we've continued further clinical trials, selling this kind of product as a point of sale, point of care product to people with lung conditions, so they can test when they might have an exacerbation. So again, like with Wanda, we asked ourselves, well, why are we interested in this company? Well, clearly, the challenge for patients is it's better if we can predict when they're going to have a problem before they have the problem. The solution is the two assays that we have, and one of them recently got a CE mark. And the opportunity, although it's smaller than the one for Wanda, it's still forecast to be £250 million worldwide. We've made really good progress with this company. We were awarded the CE mark in the past 12 months. We've won a partner in the US to supply assays to a large biotech company in the US. We're still getting grant income for the development of some of the assays in the company. And we've very recently announced another partnership with the National Jewish Hospital, which is the largest respiratory hospital in the US, where we intend to run further clinical trials. And then the last company I was going to look at in a bit of detail is a company called Glyco Tests. Glyco Tests has a diagnostic test for people that have liver cancer. And what it's particularly good at doing is detecting early stage liver cancer. And the reason why that's important is because early stage liver cancer is actually curable with surgery. And the current tests are not very good at detecting early stage liver cancer. So there's a really big sort of game-changing opportunity with the Glyco Test diagnostic. I won't explain in detail how it works because I'm not a scientist or a doctor, but I can tell you that the scientists have identified that certain sugars in the liver change when the person has cancer. And one of the sugars that is generated is this thing called fucose. And what the series of blood tests do is pick up levels of fucose that is a good signal for early stage cancer. This company too has very good pedigree. It came out of the Bloomberg Institute in New Jersey. And again, like our other companies, is well protected with patents worldwide. And then again, we asked ourselves, well, why would we invest in this company? Well, clearly, if you can have a test to detect early stage liver cancer, which is curable, that's a really good thing to have for patients. Again, it'll keep people, with late stage cancer out of hospitals. So it's a good thing for the hospital system. And we've run 2 clinical trials head to head with the existing test in the US. We came out on top, we outperformed the existing test, and we ran a third trial more recently in China, and again we beat the existing test in terms of specificity and sensitivity. And there's an enormous market opportunity for this kind of diagnostic because liver cancer at the moment, it's the 5th largest cause of death in cancer. But because of our lifestyle changes, it's going to become by 2020 the first most cause of cancer. So it's the right kind of area for this company to be in, and clearly we need to have solutions for a growing problem. We've made good progress looking at the blue column again. We've been awarded patents in the EU, the US, Japan and China. And as I mentioned, we had very recently a successful trial in China. The reason for that trial is we're negotiating with a new investor, a Chinese investor, because with the industrialization of China and the change of their lifestyles, liver cancer is becoming a problem in China too, like it is in the US. And so we're hoping, and we've already announced, to close this funding round in the next couple of months. And the funds we raise from this round will then develop the products for the US market. So really interesting opportunity at Glyco Test. So in summary, NetScientific, we look for interesting, game-changing life science opportunities. We build companies around IP. And this is a really interesting area to be in. We're also looking at doing some M&A if we can this year, because what we'd like to do is to put more companies, more assets into the company to manage, because we've got a really good board that's well accomplished at doing that. So I think that's me done. Thank you very much.
Thank you. Very nice. Do you have any questions for Ian, please? Chris, gentleman at the back, hand straight up. Can you wait for the microphone? Thank you.
Hi. It's been a very interesting talk, and I'm pleased that so many of your companies got such good prospects. Your share price isn't reflecting it. It's dropped from £2 3 years ago to 45p.
Yeah.
Any explanation?
An obvious question, and I'm glad you asked it, because it's a question we're always answering. Developing IP takes time. It's a well-used phrase, but people have to be patient. These assets, we think, will develop. We've had to clean the portfolio, which we did in 2015. We've simplified the portfolio. Our own institutional shareholders have been supportive because we've raised money since. We think it'll recover. We've gone some way to proving the model works with the exit we had a few months ago, proving we had a ×3 return. We're hoping we can continue to demonstrate that. And if we can, we're confident the share price will recover.
Thank you.
Any other questions, please? Ian, do you have a target price or an analyst? Or are people looking at your portfolio of current assets and what they think you should be worth based on that?
Yes, thank you for asking that question. It's a good one because it's good because we have two analysts come from the company. We have Stifel and we have Edison, and they've got target prices of around about 65, 70p. So broadly twice the current price.
Okay. Any other questions, please? I've got a few. So in terms of where you take those companies before divesting, do you have a target point? You're at commercialisation. Do you want to keep that commercial development, or is this really time to start thinking about the exits on those further advanced investments?
We're looking at exits now. So we're looking at what are called soft exits, where we bring in new investors to help capitalise the companies. So it'll lower our percentage holding, but drive them forward in terms of value. And then sometime after that, we'll look to do hard exits and bring cash back into the company.
And so that hard exit, you're further along the value curve, and that's where the money is?
Yes.
For the soft exit, you're not really going to be returning anything to the portfolio?
No, that's true. Soft exits build value and increase the value so that when you have a hard exit, hopefully you've got a far higher price at which you're exiting the company.
And from that original portfolio of 18, you've kept the 5. You're now keen to maybe see if there's other things out there. Do you have kind of in mind how many companies you should be investing in? Is there a figure?
That's a good question too. Probably between 5 and 10. Probably not more than 10 because that would be too many for a small team. But we could add a couple and manage quite easily, I think.
Okay. Any other questions, please? Okay, but that's it then. Thank you very much indeed, Ian. Thank you.
Thank you very much.